How did you get that 3840 again?
Okay. So we know that the mixer is 80%. When we look at the standalone prices, we see that the mixer is 80% of the total, and the warranty is 20% of the total. We apply that to the $48 because this transaction price of 48 is not the 50, right? Because of the discount.
Right.
So we're applying, basically what the point is, we're applying the discount to both the mixer and the warranty. Okay? So if you want to think about it, you're really taking a discount, 80% of the discount off the mixer and 20% off the discount off the warranty. But the way I did this math is I took $48 times 80%. The $48 transaction price, 80% is for the mixer, and 20% of that $48 is for the warranty.
Okay. I was doing it off of the $40
right
for the mixer, not the 48.
Okay.
Thanks.
All right. So that's our fourth step. And then the fifth step is just to actually recognize the revenue as we perform the obligations. So really that means doing a journal entry, which of course is what we're going to do in step 2. All right. So we're going to sell 100 of these. So we're going to get let's go with accounts receivable. And because it's early in the year and they haven't reached the 2,000, they're going to obviously pay the full price, right? So they're going to take $50 times 100. So we're going to debit accounts receivable 5,000. We're going to do discounts payable, because we're going to plan on them reaching the level that they're going to get a discount, because that's what we calculated is the most likely result. So if it's $2 for each one that we're planning on, and we sold 100 of them, that's 200 for the discount payable. Now we're going to record revenue for the amount for the mixers. So the mixer price that we came up with over here, this 38.4 times 100 mixers. That's how much actual revenue, because these were actually delivered. Okay. The warranty hasn't happened yet. So we can call that warranty or unearned revenue. Okay. As long as you have it as a liability, right? Because that's something we owe them over time. And that's going to be the 960. And so that should balance 5,000 on the left. This is the credit side. On the right. Everybody see that journal entry? Look good? All right. So the journal entry necessary on January 31st if we make adjusting entries every month. So after 1 month, we will have provided 1 month's worth of warranty. So warranty is something that we're going to provide over time. The mixer is something we provide at a single point in time. But the warranty is something that is over time. And so if we were to think about this, this was a 12-month warranty. Okay, right? So 1 year. So we're going to earn 1/12 of this unearned revenue. So we're going to debit warranty or unearned revenue for 960 divided by 12, 1 month's worth, and record it as revenue. Whoops, I put that in the wrong place. So it doesn't line up with my other journal entries. Sorry about that. There we go. I'm going to have to put it on top of my revenue. And $80. And we would do that every month for the whole year, right? To show that we've earned that unearned revenue. If it was for 2 years, we do it over 2 years. If it's 3 years, we do it over 3 years. Okay. So 2 obligations, had a discount that changed our transaction price. Otherwise, it would have just been, you know, the 40 and the 10 recognized, okay? The 40 all at once and then the 10 over time. But because of the discount, we couldn't just do the easy way. We had to do the little 80-20 thing, all right, because of the discount. Questions? Anything didn't make sense there? All right. Moving on to problem 2. All right. So we have an acquisition to start with where we bought all of the stock. So if we recall from our discussion last week, I believe, where we talked about acquiring long-term assets, especially goodwill being when we pay more for the stock than the assets are worth. Okay, so the first requirement here is to record the purchase of Cal by Brown in 2015. Okay, so we're going to do that first. All right, so we're going to pay $50 million for this acquisition. So if let's go ahead and make 2 columns, debit, credit, cash. There's going to be a credit for 50 million. Okay. We're going to debit each of the assets we purchased with the company. All right. And we're going to do it at the fair value. Now, I know this one is copied over from Word, it kind of got off, but this is the cost column. These numbers here are costs, and this is the fair value. Okay. When it was in Word. And we always record the acquisition at fair value. So we're going to put the 6350123. We're going to put down the inventory. We're going to do the building. The equipment is worth quite a bit less than what its book value is, but we're using the fair value. But the patent is worth much more, because you remember when they internally develop patents, they don't record a very high cost, but they could be worth lots. There we got all of our values, all of our assets. We have a credit for $50 million.
Could all the assets have been added up into one lump sum for the journal entry?
Well, certainly you could, okay, but you got to break it down if you're going to build yourself a balance sheet for the new company, right? I mean,
Right.
so I just, and then to make sure you don't miss something, I always list them separately. But yes, I mean, the point is that there's a debit to the assets for the fair value, okay? More so than how it's listed. Now, the difference to make this balance needs to go to Goodwill. So we're going to have to take our 50 million and subtract these other numbers to get the amount of our Goodwill. So we would have 14 million 8. Okay. There's some commas to make it a little easier to read. So that's how we would record the acquisition. Okay. So we're fast forward 3 years or so, and we're at the end of 2018, and we are looking at this company financial statements for the cow division. So this division is operating independently, which is very similar, okay, to what happens in real life. They continue to operate, and so now after 3.5 years or so, their cash is 1,500,000 because we've operated now for a little bit. Accounts receivable, 7,745,000, and that's what was given to us right up here. Okay. Inventory, because the inventory is going up and down as we buy and sell stuff, right, over the last few years. Whoops, need another 0 there. Now, the building and equipment have been being depreciated for building for 30 years and the equipment for 10 years, for 3.5 years. Okay. So you could calculate that a couple of different ways. I mean, one of the formula, you can just basically say, take the original, the building was 3.2, and then subtract from that 3,200,000 divided by 30 times 3.5, right? So that's the depreciation for the last 3.5 years. I mean, if you want to figure it out per year and add it up, that's fine. Lots of different ways, but that building would be at right there at 2,826,667. That would be our carrying amount, right? That would be how much the net building would be after accumulated depreciation. Equipment, same basic idea. Okay. 7,100,000 minus 7,100,000 divided by 10 multiplied by 3.5. All right, so $4.6 million in equipment still. All right. What about the patent? Okay. Let's see if it has any information about the patent. All right. Well, it would have been depreciating too. Okay. Right. And I think, yeah, the patent is over 15 years. Okay. That was up here. So let's do the patent in the same way. 15. Oh, wait, no. What is the patent? The patent is 14 million. 1, 2, 3 minus 14 million divided by 15 times 3.5 as well. Did I do that correctly? 14, is that right number? Oh, let's see. Oh, it's another 0. That's my problem. Didn't look right. There we go. 10,000,007. After 3.5 years of amortization, depreciation, however you want to talk about it. I'm not going to round anything or anything like that at this point, but certainly you could do that. No big deal. Okay, whatever you choose. All right. So that's the patent as it stands. Then we got to come back. We got Goodwill. And Goodwill doesn't change unless it gets impaired. So as it stands right now, it's 14.8. Okay. Now on the liability side, we know that our total liabilities, and I just lumped them all together because that's certainly not our focus right now, 4,105,000. Okay, and obviously the equity is whatever the difference is between our assets and liabilities. So the net assets or the equity would be the sum of the assets as they stand minus the liabilities. So $43 million. Okay. Assuming there's no impairment to any of the assets. All right. Now, test the patent for impairment. You always test all the assets before you test Goodwill. Okay. So we're going to test the patent for impairment. First of all, is there evidence that the use has changed? And it says here that the patents only have 3 years left. That sounds like a pretty big change to me, given that we thought it was going to last 12 more years, right? Then used 3.5, it was supposed to go 15. We're down to 3. That's a pretty big change. Okay. So I think we have impairment, but just to test, they're going to generate $2 million in cash flow in each of those 3 years. 3 times 2 million, $6 million. Is that less than the carrying amount of the patent? And yes, it's not even close. I mean, way below. Okay, way below the carrying amount of the patent. So we're going to do the fair value of the patent. And to get the fair value, once we know it's impaired, we use the fair value. We're going to do present value. I want to do it this way so you see it. And the fair value is going to be the rate. What rate did I give you? $10%. That's what I used in my answer, so I hope that's what I gave you.
10% is what's on the
Okay.
Word document.
All right, got too many things open at once. I can't see where I have it. Okay, number of periods. Well, 3 years, right? 3 times, and it's $2 million each time. So the real value is $4,973,704. Okay. So now what you would need to do in real life is you would need a journal entry for the difference. Okay. And I noticed that on our last homework, some of us would make the journal entry for this new value. Okay. When what we need to do is change our value from this to this. So we need a journal entry for the difference. So if I'm asking for a journal entry, we need the difference. If I want to know what the new value is, then I'm just going to change this patent to that. Okay. So
Can you, sorry, can you repeat that again for me?
Okay, absolutely. So the carrying amount for the patent, okay, was 10,000,007, right? 10,007,33333, right? Forever. We calculated its value as being 4.9, just under $5 million. If the question asked for a journal entry to record that impairment, we would need a journal entry for the difference between that 10.7 and the 4.9. So about $5.8 million loss. That would be a debit to loss, credit to the patent. Now this question didn't ask for journal entry, okay? It asked you to figure out what the new asset value was. And so in that case, rather than making a journal entry, all you need to do is stick the amount you came up with for the fair value in for the patent. Okay.
Okay.
So that's a little different depending on what the question is asking for, what you're trying to accomplish. All right. So now we have dealt with this impairment, and we know how to record the loss that happened. Okay, now let's recalculate the net assets after that impairment testing. So I still had a formula sitting here to add up these assets, and guess what? It just updated when I stuck in the new patent value. Okay, this number still subtracts out the liability, and we get 37,985. Okay. All right. So that is the answer to 4, the net assets for Cal after we did the impairment testing on the patent. Okay. Now, Goodwill. We need to look at what is the value of this entire company. Okay. So we found, remember the idea when we were talking about the fair value hierarchy. Level 1 was we just look it up in the Wall Street Journal. Level 2, we look at similar companies and then adjust for our company. That's what we're going to do here. We have company A, B, and C, and they are 1.5 times net assets, 1.2 times net assets, and 1.7. Okay, we're going to take the average of that. We're going to add 1.5 plus 1.2 plus 1.7, and we're going to take that and divide by 3. And I don't think it's really just really 1. I need some more decimals. 1.467. Okay. So what we just determined is that cow should be worth, okay, 1.467 times its net assets. Okay, by comparing it to other companies, we determined that it should be worth 1.467. Okay. All right. Whoops. I do that with this laptop all the time. Okay. So what we want to do in that is take out for just a minute our goodwill. Okay. I'm just going to delete that for a minute. And my net assets are $23 million without goodwill. All right. So, because anytime you're talking about net assets for the value of a company, the goodwill wouldn't be counted in that. So if I wanted to know what cow should be worth, I take my net assets and multiply by 1.467, like I just said up here, right? So based on looking at other companies, okay, we need a net assets of, or the value should be $34 million. All right, without any goodwill, we're at $23 million. So it looks like to me that we need about goodwill of about $11 million. Whoops. Okay. Now, I'm not going to worry too much about the exact, but the point is what this net asset should be what it's worth. The goodwill is that extra value beyond the physical assets. And our point here is our goodwill was actually 14.8, right? So if it's only worth 11, what does that mean? That the goodwill is also impaired by approximately, and all of these are estimated amounts, right? About 3.8 million. Okay. So more so than this whole idea of times net assets, what I wanted you to see from that is two different impairments. First of all, the patent. That should be a review of how we did impairments on those assets with future cash flows, but also how you would look at what goodwill is. Literally, this number here is what someone would pay for cow right now. So they would pay about $11 million for goodwill if all the other assets are this value. So they would pay another 11 million. Just like when we bought it, we paid 14.8 above the assets. Now it's only worth 11 million more than the assets. So something's bad's happened, okay, is the idea behind that. Two different impairment charges. Both of them would be losses, debit, loss, credit, the asset. for the actual journal entry to record those losses.
Can you do the impairment of the goodwill one more time for me?
Sure. Okay. So remember, goodwill is only the value of the entire company, right? It only happens when the whole company works together. So we look around at other companies and their value, okay, to compare it. And we find that those other companies, they are listed based on stock value. We look it up in the Wall Street Journal, right? And we find that they are worth 1.5, 1.2, 1.7 times net assets. We take the average of those three companies because those are the three companies that are most like cow, okay? So we make that a good comparison. We average together, we get 1.467. Big estimate, okay, right? This is all very fuzzy, I know, okay? Then we look at what cow is net assets, not including goodwill. What is its physical, what is its actual assets other than the goodwill? All right. We found that what it was, okay, without any goodwill, we put this at 0, and we found out at our net assets without it is about $23 million. According to this little formula up here, this 1.467, our lovely cow is worth 34 million. So the goodwill is the difference between all these assets totaled up and the 34 million. Okay. That's the liability. Okay. And we just kind of said, now in real life, we would get exactly the difference. Okay. It would be 11 point, actually it's a little under 11 million. It's about 10.8 million. Okay. But I just use that as a way of saying, because with goodwill, we are looking at really rough estimates. So the thought that it should be down to the penny is ridiculous. Okay. So about $11 million is what the goodwill is worth. The difference between all these assets and what we determine using our little formula, the value of the whole company is. Okay. So that's a rough way about how goodwill is looked at as impaired. Choosing companies is a hard thing, is a good big judgment, all that type of thing, and making them and being able to determine what their net assets are is quite a involved process. But that's basically the idea. Notice you cannot look at goodwill until you've looked at the patent. So that you would have gotten a very different answer on your goodwill if the patent was still 14 million. Okay, so you always have to do the patent, the assets first. Okay, check every other asset for impairment before you do goodwill. Yes. Leah asked, so net assets we used to multiply by the 1.467 was the total of our net assets, not including goodwill. Yes. Okay. Because when we went and did that with company A, B, and C, we should also have not included the goodwill. I mean, that's just the way you value a company. Because remember, the goodwill is a part that you spend to buy other companies. Okay, so it really doesn't apply to the value of the company you're looking at. Okay. All right. So yeah, that's a little bit tricky there. All right, but you got a chance to review the idea of impairment and redoing a balance sheet. And of course, we made it easy because I didn't give you any equity, so you just made equity or net assets be the difference between the assets and liabilities, right? So that makes the balancing the balance sheet not the main focus. All right, problem 3. We are now going to review our fun time we had with LIFO inventory. We're going to do LIFO dollar value and retail, dollar value retail inventory. Okay.
There's a question from Leah in the chat about the journal entry for problem 2.
Oh, how did I miss that? Debit loss and credit goodwill. Yes, on the for the impairment to the goodwill for about the 3.8 million. Yes, that would be the journal entry. And for the patent, it would have been debit loss and credit patent. Okay. So in real life, you would probably see that. You would not see those separated on the income statement. You see one loss, okay, for that whole, both of those. They would probably not break those two out because they would probably argue, and I would probably believe them, that the same thing caused the loss to the patent as loss to the goodwill. Whatever bad thing made the patent so much worth less is also making the company worth less. Does that make sense? So we probably just have it be one loss. That would be your more likely scenario. Okay. So we are going to start with this year, 2015. That becomes our base year, right? Okay, we always have to have a starting point with LIFO, especially dollar value LIFO, because we have to be able to measure what the change in prices are. And we do know that the prices are 3% at the end of the year higher than at the beginning. Okay, so we're going to use that in a minute here. But we generally need to apply and figure out our percentage of our cost percentage first. All right. So if you're looking at the numbers we were given, okay, we've got our inventory beginning at cost and retail. We got our purchases at cost and retail. We got the markups. Whoops, should be over in. Let's move this. Cut. That's a little confusing. So those. Okay. So when you're looking at your cost to retail percentage, we take the 833,000 because we're applying lower of cost or market. So we ignore beginning inventory. We take just the purchases and we divide it by 1,255,000, 123, plus the markups, but we don't subtract the markdowns. Got too many zeros in. Yeah, I think I got too many zeros. That's why I only get 6%. That's a little better. 64.7. I'm just going to leave the whole number there. Okay. So that is our cost retail percentage. We know we started with 203. Let's go calculate what our ending retail ending. We start with this. We add in our purchases. We add the markups. We subtract the markdowns. And then we subtract from that sales. 1,247, 123. That was given right here, right? And our ending at retail is right there, 229,000. Now we got to take out the inflation, right? To see if we have, okay, a new layer. So we 229 divided by 1.03, because that's how we divide to take out inflation, and 220 to 330. So yes, that's higher than 203. So we have a new layer. Okay, and that new layer is the 222, 310 minus the 203, right? 19,330. All right, now we have two calculations we need to apply to that 19,330. We need to put the inflation back and use our cost percentage, okay? And it doesn't matter because we're multiplying. It doesn't matter which one you do first, okay? I usually do the inflation first, but again, it's going to come up to the same result. Okay, 12,887 rounded. So what is our ending inventory? Well, okay, it's going to be the beginning. It's going to be this number, right? Plus our new layer. Okay. $159,887. That's what you'd see on the actual balance sheet. So all of these others were preliminary calculations that you would have utilized. Okay. Now, here's our formula. We start with 147 beginning inventory, purchases 833, minus our ending inventory, and that, my friends, is what? Cost of goods sold. All right. We would take that, the sales are here, so we can get our gross profit, right? 1,247,000 minus the cost of goods sold gives us our gross profit. Gross profit divided by sales gives us our gross margin. Now, the problem actually didn't ask for it this year. It asks for the other 2 years, but it's the same process. Okay. Question about that? Anything concerning there? All right, let's try it again. Okay. So we're on to the next year. Oh, got a question. 0.6427, where did it come from? Okay. If you look at the formula, we took the net purchases and we divided it by the retail net purchases plus the markups. That gives us lower of cost or market. Remember, I gave you a chart that showed you 3 or 4 different ways you can get that percentage depending on what you're doing. If you're doing weighted average, if you're doing LIFO, if you're doing lower of cost or market or not. Okay. That LIFO, lower of cost or market, uses net purchases, retail, and markups. Okay. So that's where that came from. So on to the next year, and we're going to do literally the same thing, right? As far as that percentage, that cost of retail. We're going to take the net purchases. We're going to divide by, oops, markups are a little off kilter here, but we don't subtract the markdowns, just add the markups. Okay. Now, a little hint, these cost of retail percentages should be pretty similar year to year. If you come up with something really different, that means you probably pulled a number wrong, typed it in wrong, something like that. Okay, so you would not expect this to be 64.7 and this to be 37% or something like that. All right, so just a little warning. All right, so now we need to go ending at retail. So we start with the beginning at retail, which is the year before. Okay, and then we have our net purchases plus our markups minus our markdowns minus our sales. I have to type in because I put it in as a word instead of a formula. And we're at 397,100. Ending at retail. Okay. Definitely looks like we have a new layer, but let's make sure we take that and divide by 1.08 because that was our new percentage. We're 8% higher than the beginning of 2015. So we're at 367, 685. We compare that to the last time we took out 222, and yeah, we got a big old fat old layer. I hate when that does that. There we go. Okay. So what is our new layer? We take this without, this one doesn't have any inflation in it, and we compare it to the last time we didn't have inflation in it, and there we go, 145, 355. We're then going to put the inflation back by multiplying for just that layer, and then we're going to do the cost percentage, the one for the current year, and our new layer is just under $101,000. Okay, ending inventory. It's going to be your ending inventory for the month the time before plus that, right? So we're going to take what we got last time plus our new layer at cost, and we're at 260, 777. And we could fill in the same things. We know what our beginning, this is our beginning inventory. We have our purchases over here. Okay. Subtract our any inventory, we get cost of goods sold, all that good stuff. Okay. All right. I have a feeling that we're going to do a, how'd you get the percentage to get the new layer again? Which this one, 64 or the 108? The 108 was the 8% higher, okay? The 64, you can see the formula right there, okay? Net purchases divided by the retail value of the net purchases plus the markups. And if you do it in a formula like that, make sure you put it in parentheses, right? Or you're going to get a screwy result from a mathematical standpoint. So let's see if we have a liquidation this last time to add some excitement to our lives on this problem, okay? So first of all, we do the cost of retail. We take the net purchases divided by the retail value of the net purchases plus the markups, like we've done. And then look for that. We got really close to the same one. In fact, if we had done it wrong and used the one before, we probably wouldn't be able to tell, probably round off to about the same anyways, okay? Now, all right. So let's see, our ending at retail. That's what we need next. So we take our beginning, which was last year's ending, plus our purchases, plus our markups, minus our markdowns, minus our sales of, whoops, I didn't do a minus, I did a underscore, 1621800, 303,500. I have a feeling we're missing some layers, but before we know for sure, we have to take out the inflation by dividing by 1.12. That was our new inflation, our 12% higher. So with inflation taken out at retail, it's 270,982. All right. So that's not more than this. So there's not a new layer. It's less than the year before. Okay. So we go back to the year before that. Okay. And we see that, it's higher than that. Okay. So our layer, it's not new this time, okay, is the difference between that. We go back until we find a calculation without the inflation where we're higher, okay, where we don't get a negative number. All right, we actually did one where we had to do all the way back to this original cost in our homework when we did this but not this time. Sorry about that. All right. So our layer is 48,652. In comparison to this. Now, here's the tricky part, okay? This layer is not from 2017, okay? It's actually from 2016, all right? This was a layer that was added in 2016. And so when we multiply here, now remember we have to apply put the inflation back, and we have to multiply by the cost percentage. And this time we're going to do this, we're going to multiply it by 1.08. Why not 1.12? Because it's not from this year. It's from this year. So we use a 8% that belongs to that year, 2016. And we also use the cost percentage for that year. Okay, so we peeled off, we don't have any layer for 2017, and we peeled back some of the layer for 2016, but the remaining layer needs to be adjusted based on the percentages for that year. Okay. Now, let's be real honest. If you would have used this versus this, your difference would be like $3 or something. So when the cost percentages are that close and that consistent, it probably doesn't make a lot of difference which year you use. But you should use the year that the layer was created. Okay. So your ending inventory, okay, is going to be, all right. Now, we need to go back to this year, right? Plus that, okay? 193. So you can't use this year, right? Because that part of that layer is gone, right? So you have to go back to the year before. And that's the tricky part of a LIFO liquidation, right? Is because you've got to figure out which year to go back to. All right. It's literally as if now for our going forward is as if this year never happened. So like for instance, the next year, okay, we would just go right back compared to this year, right? Because this year is gone. Nothing that happened this year stays, because remember, LIFO means you're selling the most recent stuff you bought, and the most recent stuff you bought all got sold. So there's nothing, our assumption is there's nothing we bought in 2017 that's still in our inventory. It's all gone. So it's as if never happened. Okay. All right. Questions on that? But yeah, we usually do these first two just fine. It's the selling through the layers that tends to give us a little trouble. Okay, Laura, did you?
Yeah, so in the third year in 2017, to find a new layer, you took the first ending inventory for like the 222, 330 minus the 270.
Yep. Well,
Okay.
270 minus the 222. Yes.
Right.
I compared it. I had to go back until I found remember, the thing that you need to remember is this is without inflation. Okay.
Okay.
And this is without inflation. And the point is, you have to compare without inflation. You can't compare this number to this number, right? Because that's with inflation. This is without. You've got to go back and compare it to without inflation numbers. Otherwise, you're going to come to the wrong conclusion. So you go back until you find a number that's lower than what you're working with.
Right, because we got rid of a layer.
Yep. And I mean, it could be that you have to go all the way back to this beginning 147. I mean, if you really have a liquidation.
Right. Okay.
Okay.
Because that was the base year, the 147.
Right. And if this number was below 147, you're done, right? Because that's just your
new base.
That's your new base.
Okay. Thanks.
Okay. Yeah. No, I mean, I should have said the 203. Yeah, because this is still at retail. We would have had to have gone just below the 203. You would have compared to 147. Okay. But yeah, that's how low you would have had to go. But if you'd have gotten anything here less than 203, you would have been done. You would have had no layers, okay? And you would have just multiplied by your cost percentage, this original cost percentage, and be done. Okay. No inflation, nothing, because you're literally back to the where there was no inflation, at least pretending there was no inflation. Okay. All right. Moving on to problem 4. Some loan receivables. Okay. So we've got 3 banks, A, B, and C. All right. Now we're going to do it from the bank side, not from Tiger's side. Okay. We're worried about the loan restructuring for the banks. Now, what did we learn about note receivables for banks? If there's any change in the terms, it's impaired, right? We don't have to do the whole recoverability test or anything like that, because if a bank is going to give you any better deal, then it has to be a better deal for the customer, and that means they're paying less, which means that it's impaired. Okay, so first thing we need to do is get the carrying amount of the loan. Okay, so it's what the balance is plus any unpaid interest. So our carrying amount is going to be 428,554 plus 12,499. We don't need an amortization table or anything like that, like we had to do in our example or the homework. We had to figure out, actually, you didn't have to do that. I had done that for you, but as long as you know what a balance is due on the loan, then that's the carrying amount. B is 136 plus 3632. Whoops, I should put it in the same spot. And finally, 109, right? Okay. So there's no need to do the first step of an impairment test. We know they're impaired. We gave them a better deal. Okay. So we can go right to the fair value of these loans. Okay. Now, what is Bank A going to accept? $2,900 per month for the next 10 years. Okay. So that's 2,900, 120 times, right? We have to do that. So we're going to set up our present value of those future cash flows to figure out what the value is. And what rate do we use? We always use the original rate, okay, which for this loan was 7%. Okay, and we're going to go ahead and divide that by 12, right, because we're doing monthly payments. Number of payments is 12 per year times 10, or you just put 120 in if you want, whatever. And the payment, 2,900. That's what was agreed to. That's the new deal on this loan. So the fair value of that loan is 249,766. So the loss is the difference. $191,287. So you would debit loss, credit loan receivable for $191,287. 287, yeah. Okay. Now, B, repossession of collateral. Okay. So the collateral, we're going to repossess the building, all right, which has a carrying amount of 94,625. So the bank is going to repossess that. So what are they going to get? They're going to get, okay, $135,000 building, right? So the loss is the difference. Again, no need to do present value because we're going to assume we can do that right away. Whoops. Let me use the underscore again. So debit loss, credit, note receivable. You could actually go so far as, depending if you think that if you're going to go ahead and repossess the building, you could repossess the building and put it as building debit 135, credit loan receivable, debit loss. Okay, if you're literally ready to repossess now and take ownership of that building. Okay. So really, I mean, it seems like it's different, but it's really much easier because you don't have those future payments that you have to do any present value on. Okay. And the last one is going to be a payment of $1,003 for the next 10 years. Okay. So again, we're going to do the present value. We're going to use the rate we originally used, and that's 9% divided by 12. It's also 12 times 10, and the payment is, so the fair value is 79. So your loss, you're never going to have a gain, right? The bank is always going to lose, okay, when it's impaired.
But if we were looking for the journal entries for Tiger Corp instead of the bank, then we would have done the gains.
Yes, then there could
Yeah,
be a gain on the side of the borrower. Yes, they can be a gain. Now, we did not, it's actually a little more specific. It's not the same amount as the loss for the bank. And we did not, we talked about the possibility of a gain, but we did not go into detail about how that could be different than the amount of the loss. And so I'm not worried about you needing to do that. Okay.
Okay.
But it's one of the weird things in accounting. We try most of the time that both sides of the transaction are the same, at least the same amount. So if loss on one side, gain on the other, whatever. But this is one area where they tweak the rules such that it doesn't end up being the same ever. It will never be the same. Okay. And so it's just not, there's enough caveats that I decided not to, teach that anymore into this scenario. So we'll just focus on the lenders. So that's your loss would be 29, debit loss, credit, note receivable again. Now, it also asked for the journal entry for the loan. Okay, and this is just to make sure that you understand that with these new terms, you still have the same journal entries that you would have otherwise, right? So you're going to debit cash, for instance, for Bank A is going to debit cash for $2,900, right? That's how much is going to get paid by Tiger to the Bank A, all right? And they're going to debit or credit interest revenue and credit note receivable. And interest, you always calculate interest, whether it's receivable, payable, always first. Okay. What is my new value of the loan? Okay. 249,766. Now I'm rounding a little bit. Times, and what rate of interest did we use? 7%. If you don't use 7%, it's not going to work over time, right? Because that's how we calculated the value. Okay. And divide that by 12 because it's only for 1 month. There's your interest. Whoops. And so take the difference, and that's your principal, if you will, that you're receiving from Tiger. Okay. And it would be the same basic idea with the $1,003 you're getting for if you were Bank C. And of course, there's no payments for Bank B, which is why we didn't ask for the journal entries. So that is the test review. 4 problems. Okay. We did our revenue recognition. We did some impairments. We did inventory. And we did some more loan specific impairments. Okay. Questions? The test is in the Dropbox, ready to go. Okay. There's a discussion for questions for the test or this review. If you think of something after we've all, you know, hit you and you're laying in bed tonight and you need to ask me a question, that'll be, you do that right there on that discussion. And if there's anything unclear on the exam, please ask it there. It's fine. And I will respond. And that is not just like last time, that is not cheating. Okay. Ask questions. So please feel free to do so. Anything else?
Can I ask a off-topic question?
Sure.
I had you last year for federal income taxes.
Ah, yes.
What happens with these checks that we're supposed to be getting? Does that mean the $1,200 plus $500 for kid, you don't get any money in 2021? Like, I can't.
That's how I understand it, but I haven't read the details yet. And I have a feeling that may change as they go through. I mean, but really, it's right now. It's supposed to be a loan, so at least that's how I saw the explanation. But those are the kinds of things that takes a while for the IRS and the guidance to catch up with. Congress passes it, sends out the money, and then we have to wait a couple of months for them to tell us exactly how it's going to play out. So
Okay, it just seemed weird that we're all just getting free money because you don't get free money. And my mom had said when they'd done this before, they took taxes out, but they're not saying they're taking taxes out.
no,
But
I don't. There won't be any withholding on these. I'm pretty sure.
okay.
So.
And I tried to find, stuff through like Journal of Accountancy and everything, but nobody's
ready to say one way or the other yet.
Yeah.
So everybody's waiting to see the fine print, you might say.
Yeah.
You are right to be skeptical.
Yeah. Well, you don't want to go out and spend it if, you're counting on that every March or something to like pay off bills.
Yeah.
But I guess people need it now too.
Yeah, exactly. That's the idea. So. All right, Leah says, what was the calculation for interest revenue, note receivable? Okay, interest revenue, see the formula up in the, you take the new balance, and that's why I want you to emphasize not what the carrying amount was before the impairment, but the amount after the impairment times the original interest rate, and then divide it by 12 because we're doing monthly payments. Okay, and remember that note receivable is just the difference between the cash paid and the interest revenue. Always calculate interest revenue, whatever's left is the note receivable. And that's the same principle if this was a note payable, if you were figuring out how the journal entry for how much you're paying.
So for the last test, nobody did as well as we had hoped, and you let us make corrections. I'm just curious if we managed to not do well again, which we won't. We'll all do amazing. But what then?
Then we'll probably consider the same things. So, yeah, I believe in learning from our mistakes, and so that's, you know, I feel like that's the, you know, the best way for us to make sure we've learned this material. Then that's what we'll do. So if that relieves a little pressure, so you can think clearly, so be it. That's the point, because we tend not to do our best work when we're uptight. So take a deep breath, relax. It's going to be fine. And, you know, that sort of thing. All right. Anybody else? Well, thank you. Stay safe and well. Wear a mask when you go outside, or whatever you need to do to stay away from those viruses, so we can stay healthy, because nobody wants to do this. Go to the hospital right at this point. And don't do anything else risky either, because you don't want to go to the hospital and have to wear a hazmat suit or anything like either. So just be careful. All right. Talk to you soon. Good luck, everyone. Have a great weekend.